If you're thinking about buying in Texas right now, listen very carefully. We just finished going through every major Texas housing market for 2025, and what we found is simple. There are 3 cities that will quietly destroy your wealth, and 4 cities that can realistically build it. Most people have no idea which is which. You're not going to be one of those people. The Texas paradox. Here's what shocked us. One of Texas's big 4 cities has already seen home prices crash 19% from peak. A completely overlooked military town with $254,000 homes is now appreciating faster than Austin did during the pandemic boom. Texas added 562,941 new residents in 2024. That's literally a full city the size of Albuquerque. Yet inventory is up 40% in several major markets. That's the Texas paradox. Some cities are absolute gold mines. Others, 50 miles down the road, are slow-motion financial wrecks. Today, we're going to separate those two. By the end, you'll know. The 3 Texas markets to avoid at all costs in 2025. The 4 markets where smart money should be positioning right now. And this isn't based on vibes. It's based on prices, rents, inventory, jobs, migration, construction. Let's start with the big picture, then drill down city by city. Texas in 2025. The inflection point. The pandemic boom lit Texas on fire. From 2022, prices in many metros surged 40 to 60%. Investors piled in, locals got priced out, builders went into overdrive. Now we're in the normalization and correction phase. Statewide median home price, $335,171 mortgage rates, stuck around 6 to 7%, inventory climbing in key markets. Rents falling in some places, holding or rising in others. That 6 to 7% mortgage rate is not just a number. It defines who can buy, where, and at what price point. In some cities, these rates have turned properties into steals. In others, they've turned them into leveraged grenades. Big example, San Antonio, one of the 4 major Texas metros, just saw rents crash 8.2% year over year. While other cities hold steady or rise, San Antonio's rent slide is your first major red flag. Now let's get specific and start with the 3 worst markets. These are the places that can quietly erase years of your work if you buy wrong. The 3 worst Texas markets for 2025. Avoid at all costs list. The number 3, San Antonio, the softest major metro in Texas. San Antonio looks harmless on the surface. Big metro military presence. Tourism, lower home prices than Austin or Dallas, but under the hood, it's the weakest of the big 4. Let's break it down. Median home price fell 3% in 2024 to around $308,011, the worst performance among Texas's major metros. Rents are crashing, year-over-year rental declines of 8.2%. Multifamily permits are down 73%, but there's still a flood of units hitting the market from the previous building wave. This is what you get when supply keeps coming online. Demand isn't growing fast enough, wages don't support higher rents. Market signals, days on market, 75 days, the slowest of all major Texas metros. Inventory, 5.2 months, textbook deep buyer's market territory. That sounds nice if you're shopping. It's a nightmare if you're trying to build equity or cash flow. Jobs? San Antonio added jobs at 2.6%, but heavily in lower wage sectors. Hospitality, healthcare support, military-adjacent services. These jobs don't create strong, sustained pressure on mid to high-tier housing. For first-time buyers, yes, it's affordable. The Housing Affordability Index is around 1.26, meaning median incomes can comfortably buy median homes. But affordability alone doesn't make you money. You're buying into weak rents, slow sales flat, or negative price appreciation. Expect low or no real equity growth for years. For investors, this is where we're blunt. Falling rents, 9 to 10% vacancy. Soft prices, that is a dead investment thesis. The risk-reward profile is terrible. San Antonio is a wait-and-see market for at least the next 12-18 months. Number 2, Midland and Odessa, Permian Basin, the oil-driven time bomb. Now let's talk about the oil twins, Midland and Odessa in the Permian Basin. On paper, they look incredible. Midland unemployment, 2.4%, the lowest in America. Median price up 11.5% to $368,035. So what's the problem? Everything depends on oil. Roughly 20% of the workforce is directly tied to oil and gas. Thousands more are tied indirectly. Housing demand rises and falls with the rig count and global oil prices. Look at the history. In the 2014-2015 oil bust, Odessa's employment dropped 13%, losing 23,800 jobs almost overnight. The 2020 oil crash smashed both cities again. On top of that, a significant share of workers operate on 14 days on, 14 days off schedules. This creates highly volatile rental demand. Boom years, great yields, bust years, vacancy, forced sales, panic. For first-time buyers, unless your income is directly oil-based and you understand the risk, this isn't a home. It's a leveraged bet. A downturn could trap you in a falling price market with job risk and very limited resale demand. For investors, let's be clear. This isn't investing. It's speculation on energy markets. You only touch this if you deeply understand oil economics, you can stomach violent cycles, you can afford to watch your equity evaporate in a downturn. If that's not you, stay out. Number 1, Austin, the fall from grace. This one hurts. Austin was the darling of Texas real estate, tech hub, cool city, explosive growth. Next, Silicon Valley. Now, Austin is the most dangerous major market in Texas for 2025. Here's why. Peak median price, April 2022. Over $550,000 current range, $445,000, $512,500 depending on methodology. That's a 9 to 19% price correction, one of the steepest among major U.S. metros. Supply and demand, inventory, 5.7 months, the highest in 13 years. Days on market, 188 days are wise, roughly double the pandemic frenzy days. You went from 24 to 48 hour gone instantly to nearly 3 months on the market. Apartments, vacancy, 9.85%, nearly triple the 3.97% seen in 2021. Over 26,000 new units recently dumped on the market. Two-bedroom rents down 17% from peak, from $1,125 to $1,126 per month. Now look at jobs. The engine of Austin's boom was tech. That engine is misfiring. The information technology sector shed 2,900 jobs in 2024. That's a 5.7% decline in the very sector that pushed prices into orbit. Unemployment overall is still fine at 3.5%. But high-paying tech jobs are what justified those insane prices. When those jobs go, the premium goes too. For investors, cap rates, 3.34, 3.67%, declining rents, rising vacancies, falling home prices. That equation does not work. You cannot buy low cap rate property in a falling, oversupplied, high-cost market and call that smart. It's not. For first-time buyers, the only silver lining. You finally have negotiating power. Homes selling at 96% of list sellers offering concessions again. But understand something, you are catching a falling knife. If you buy now, you must be thinking 7 to 10 plus year horizon and have zero dependence on short-term appreciation. The 4 best Texas markets for 2025, where smart money goes, list. Now that we've covered where not to put your money, let's go to the good part. The 4 markets where the numbers actually line up. Number 4, Amarillo. Quiet, boring, and exactly what you want. Amarillo isn't flashy. It's not on Instagram relocation trend videos. That's exactly why it works. Key stats: unemployment, 2.6%, second lowest in Texas, median home price, around $247,000 appreciation, 3.3–6.4% depending on time frame. This is what a fundamentally healthy market looks like. No mania, no collapse, just slow, steady robustness. Economic base, Tyson Foods and other food processing, healthcare, agriculture, and manufacturing. No dependence on tech bubbles or oil spikes. Market signals, unemployment, stable between 2.6 to 3.1% days on market, 171 days, moderate, not distressed. Sale to list ratio, buy 98%, realistic pricing, not desperation. New single-family permits, 209 in 1H 2025 versus 262 in 1H 2024. Builders are conservative, avoiding oversupply. For first-time buyers, this is a buy and hold for life type city. You won't brag about 20% gains in a year, but you also won't wake up to a 19% crash. You build quietly, low entry costs, stable job base. Gradual appreciation for investors, 2.6% unemployment, strong rental demand. Sub 300K homes make entry realistic. Single family in the 200K, 280K zone near key employers can actually cash flow. Amarillo isn't sexy, it's just solid, and solid builds wealth. Number 3, Killeen, Fort Hood. The military engine. This is the little military town most people sleep on and shouldn't. Median home price, $254,000, roughly 24% cheaper than the Texas median appreciation, 1.97.65% in 2024, depending on measurement. While Austin and others are correcting, Killeen is still moving upward. Why? The base. Fort Hood, Fort Cavazos. Name reverted back to Fort Hood in June 2025. One of the largest military installations in the U.S., a constant, federal-backed demand engine for housing. Military demand doesn't care about tech layoffs, doesn't move with oil busts, isn't tied to corporate relocation cycles. Market metrics, home sales up 7.1% year-over-year, inventory at 5.3 months. Balanced, not flooded metro population, Temple Killeen MSA, 891,464 currently. Projected 931,992 by 2030, 4.5%. Projected 978 and 957 by 2035, planning 0.8%. Days on market, 49 of 58 days, healthy, neither red, hot, nor dead. For first-time buyers, you can buy a 3-bedroom home for about $250K in a market with stable demand and growing population without taking on insane monthly payments. For investors, this is almost textbook. Affordable entry, steady appreciation, durable rental demand, economic anchor that doesn't vanish when a single industry sneezes. You won't get the Austin hype, and that's a good thing. Number 2, Fort Worth, the big city sweet spot. Fort Worth just crossed 1 million residents in 2024, but it still behaves like a disciplined market, not a manic one. Median home price, $330,340, roughly 15-20% cheaper than Dallas market speed, 31-38 days on market, fastest sales velocity in North Texas. As an investment market, Fort Worth absolutely embarrasses many peers. Key metrics, cap rates, 5.6, 5.7%. Actual cash flow potential. Occupancy, 92.2%. Units fill in about 41 days on average. Affordability. About 29.3% of homes are affordable to median income buyers versus Dallas at 27.3% and Austin far worse. Job base, manufacturing, aviation, Bell Helicopter and others. Logistics, financial services. Population adding 23,000, 27,000 residents annually. Growth is accelerating, not slowing. Construction jobs, around 3,700, indicating healthy building activity without unhinged overbuild. For first-time buyers, Fort Worth is that rare combo. Big city amenities, jobs, culture, sports. Still within reach financially, price-to-income ratio of 3 to 3.8x versus Dallas at 4.4x and Austin beyond that. For investors, 5.6% plus cap rates, 92% plus occupancy. Sub 40-day DOM, ongoing population and job growth. That's one of the best risk-adjusted returns in Texas right now. Houston, the quiet giant. Houston doesn't get the hype Austin does, but it wins on fundamentals. Median home price, $334,900, up 2.75.2% year-over-year. Average price, record $443,360 in July 2024. So prices are growing, not collapsing. And still cheaper than Austin and Dallas. Jobs, 81,700 new jobs in the 12 months through May 2024. Unemployment, 4.2%. Population gained, 43,217. Residents from July 2023 to July 2024. Second largest numeric gain of any U.S. metro, behind only New York City housing. Harris County added 32,000 housing units. Most in the nation. Inventory sits at about 5.2 months. Slightly elevated, but far from panic territory. Homes move in around 55 days. Rentals. Single-family rental leases, 44,551 in 2024, up 3.3%. Total single-family rental volume, $103 million, up 6% year-over-year. Economic base, Energy Medical, Texas Medical Center, 100,000 plus employees. Aerospace Logistics Technology. That diversification gives Houston something Austin doesn't: recession resistance. For first-time buyers, you get a major metro with real upward price movement, still priced at a level where ownership is realistic, with negotiating power due to modestly elevated inventory. For investors, strong rental demand, ongoing appreciation. 11 to 12% cash-on-cash returns with financing are achievable in the right neighborhoods. Houston is, in our view, the best all-around major Texas market for 2025. Macro forces you cannot ignore in Texas. Now, let's zoom back out. 3 big forces will decide whether you win or lose in Texas real estate in 2025. 1. Interest rates and the lock-in effect. Fed cut rates 3 times in 2024. Mortgage rates still stuck around 6.57%. Millions of owners locked into 2-3% loans are not selling. This creates low resale inventory in some submarkets. High entry costs for new buyers, a stalemate. If mortgage rates drop to 5.5 to 6%, sellers will finally list. Buyers will swarm. Some markets, Houston, Fort Worth, will ignite. If rates spike to 7.5 to 8%, transaction volume could drop 20-30%. Already weak markets, Austin, San Antonio, get punished harder. You cannot control rates, but you must price your decisions around them. 2. Population growth and who's actually coming. Texas is still the growth king. 562,941 residents from July 2023 to July 2024, 14th straight year leading the nation. But the composition changed. Net domestic migration, just 85,267, way down from 300K plus pandemic peaks. International migration, 319,569. Natural increase, births, deaths, 158,753. What this means: more lower-earning new residents initially, stronger rental demand. Slower home buying at the entry tier. Also, 102 of 254. Texas counties are losing population. Growth is heavily concentrated in major metros and select mid-size markets. 3. Construction, oversupply, and reset. Texas issued 158,821 single-family permits in 2024, up 5.5%. Most of that is concentrated in a handful of metros. Apartment sector delivered 116,000 plus units in 2024. That's why Austin, Dallas, and San Antonio are now drowning in multifamily oversupply. The good news: new multifamily starts have collapsed. 2025-2026 deliveries expected around 55,000 units, less than half of 2024. By 2026, rental markets should have absorbed most of this glut strategy. In 2025, what smart men actually do for first-time buyers: focus on affordability, job stability, holding period, minimum 7 to 10 years. Best entry markets: Fort Worth, 330K median, big city upside, still reasonably priced. Killeen, 254K median, military demand, steady appreciation. Amarillo, 247K median, ultra-low unemployment, quiet long-term growth. Avoid Austin unless you have large down payment, strong income, and long-time horizon oil-heavy markets. Midland, Odessa, unless your entire career is rooted there. San Antonio, until rent declines and oversupply show clear signs of stabilizing. For rental property investors, best plays: Houston, strongest major metro fundamentals; Fort Worth, best cap rate, plus growth combo. Focus on single-family homes in the 250K, 400K range. Good school zones near employment centers. Avoid competing with thousands of new apartments. Be extremely cautious with fix and flip in slower markets. Luxury bets in correcting markets. Thin margin deals that only work if prices spike. This is not 2021. Buyers have options. You do not get bailed out by blind appreciation anymore. For flippers, this is the toughest environment in a decade. DOM has doubled in many cities. Buyers are negotiating again. Homes are selling at 92-98% of list, not over asking. Inspection leverage is back. If you insist on flipping, stick to Houston's faster-moving submarkets. Buy cheap, clean, and simple. Have realistic ARVs and long holding capacity. Final verdict: The 2020 to 2022 frenzy broke Texas's housing market in many places. Locals priced out investors' over-levered markets, unhinged from jobs and wages. The 2024-2025 correction is painful, but necessary. It's bringing prices back toward wage reality. Opportunities back for serious buyers, margin. Back for disciplined investors. The best opportunities in 2025 are in markets that never went full bubble mode. Have real diversified job bases, still offer sane prices relative to income. That's Houston, large, diverse, appreciating Fort Worth. Big city, good cap rates, strong growth. Killeen, stable, military-backed demand. Affordable Amarillo, low risk, slow and steady equity builder. Avoid Austin, high prices, weak rents, high vacancies. Tech hit, Midland, Odessa, oil roulette. San Antonio, rents falling, oversupplied, weak fundamentals. Texas is still the most dynamic growth state in the country. No state income tax, pro-business environment, massive job creation. But in this phase, market selection matters more than ever. Choose wisely, underwrite conservatively, and don't confuse speculation with strategy. Now I want to hear from you. Are you buying, holding, or selling in Texas? Which city from this list surprised you the most? Drop it in the comments. If this breakdown helped you avoid a bad decision or see a new opportunity more clearly, hit that like button and subscribe for more data-driven real estate analysis. Until next time, invest with your brain, not your emotions, and let the numbers lead.